Right now, at this very moment, Warren Buffett is sitting on $325 billion in cash, not million, billion. The largest cash hoard in corporate history. Jeff Bezos just sold $13 billion in Amazon stock. Central banks worldwide are buying gold at rates we haven't seen in 70 years. And hedge funds are quietly placing massive bets that markets will crash within 18 months. This isn't random, this is a pattern. The same exact pattern that played out before the 1929 crash, before Black Monday in 1987, and before the 2008 financial crisis. 3 specific trades, made in the same sequence, every single time. And if you don't understand what these 3 trades are and why they're happening right now, you're about to lose 30, 40, maybe 50% of everything you have invested. But here's the thing. If you do understand this pattern, you're about to witness the greatest wealth transfer opportunity of your lifetime. Stay with me for the next 12 minutes, because I'm going to show you exactly what's happening, why it's happening, and most importantly, what you can do about it before it's too late. Let me take you back to Joseph Kennedy, one of the most aggressive speculators of the Roaring '20s, made 3 specific trades 6 months before the crash. The market was at all-time highs. Everyone was euphoric. Cocktail parties were full of stock tips. Even shoeshine boys were giving investment advice. But Kennedy saw something nobody else saw. He made 3 trades, converted his stocks to cash, bought gold, and bet on volatility. 6 months later, the market crashed 89%, while millions of Americans lost everything. Kennedy walked away with $50 million. That's about $800 million in today's money. Now fast forward to October 19, 1987. Tudor Jones, a hedge fund manager, made the exact same 3 trades: cash, gold, volatility bets. That day, the market fell 22.6% in a single session, the largest one-day crash in history. Jones made $100 million. In one day, 2008, Michael Burry, John Paulson, and a handful of others saw the housing bubble. They made the same 3 trades: cash, gold, volatility. The financial system collapsed. Banks failed. People lost their homes. The S&P 500 fell 57%. But these guys, Burry made $700 million. Paulson made $4 billion personally, $20 billion across his funds. Now here's where it gets interesting. It's single quotes S. 2025. And the exact same 3 trades are being made right now by the smartest money in the world. 2 trades. Not 5, 3, the same 3. Why? Because crashes aren't random, they follow a mechanical sequence. And these 3 trades address every single phase of that sequence. Let me show you exactly what they are. Trade number 1 is the cash conversion. This happens 12 to 18 months before the crash. It's the earliest warning signal. Think about it logically. If you're a billionaire investor and you see trouble coming, what's the first thing you do? You get out, you sell your positions, you raise cash, you preserve capital. But here's the key. You don't do it all at once, because that would crash the market and you'd get terrible prices. You do it systematically over several months. Let's look at what happened before each crash. 1929. Joseph Kennedy started selling in the summer. By September, he was substantially in cash. The market peaked September 3rd. The crash began 7 weeks later, 1987. Tudor Jones reduced his positions throughout August and early September. He even wrote memos to his investors saying, "I expect a major crash by October." The market peaked October 2nd. It crashed 17 days later, 2008. Michael Burry stopped buying stocks in 2005. Warren Buffett's cash position grew from $40 billion to over $60 billion by 2007. Saw it coming and they got out. Now look at 2025. Warren Buffett isn't just holding cash. He's sitting on $325 billion. He sold 50% of his Apple position. He's been dumping Bank of America shares. And in his latest shareholder letter, he said something absolutely critical. We cannot find anything attractively priced. Translation: everything is overvalued. Get out now. But it's not just Buffett. Jeff Bezos, $13 billion in Amazon. Stocks sold. Mark Zuckerberg, billions in Meta shares sold at all-time highs. Jamie Dimon, CEO of JP Morgan, sold stock for the first time ever in his tenure. Insider selling across corporate America is at levels we haven't seen since, wait for it, 2007, right before the last crash. These people run the companies. They see the real numbers, the real customer data, the real problems, and they're getting out. Trade 1 is happening right now. The smart money has already exited. But here's the problem with just holding cash. You're sitting in cash. You've protected yourself from the crash. But now you have a different problem: inflation and currency devaluation. When markets crash, what does the Federal Reserve do? They print money, trillions of dollars. They did it in 2008. They did it in 2020. They'll do it again. And when they print money, your cash loses purchasing power. This is where trade 2 comes in. Gold. Gold has been the ultimate store of value for 5,000 years. It's survived every empire, every currency collapse, every financial crisis. Let me show you how this played out. 1929. Bernard Baruch converted substantial positions to physical gold. When the crash came, gold maintained its value. But here's the kicker. In 1934, when Roosevelt devalued the dollar by revaluing gold from $20 to $35 per ounce, anyone holding gold saw a 69% gain overnight. 1,987 gold spiked from $300 to $475 during the October crash, a 58% gain while stocks were collapsing. 2008? This is where it gets really interesting. Gold was around $600 in 2007. As the financial crisis unfolded, gold surged to $1,000, then $1,200, eventually hitting $1,900 by 2011. John Paulson, after making billions shorting mortgages, deployed massive capital into gold. His gold fund made billions more on top of his mortgage short gains. Why? Because he knew the Fed would print unlimited money to bail out the system, and money printing means gold goes up. Now look at 2025. Gold is trading at $2,850 per ounce. Record highs. Why? Because central banks are buying at unprecedented rates. In 2022, 2023, and 2024, central banks purchased over 3,000 tons of gold, the highest three-year total since data collection began in 1950. China is buying. Russia is buying. India, Turkey, Poland, Singapore, all accumulating gold. They're not doing this randomly. They see the same thing the smart money sees: unsustainable U.S. debt, inevitable currency devaluation, systemic risk. Ray Dalio has been vocal. Hold 5 to 10% of your portfolio in gold. Stanley Druckenmiller disclosed significant gold positions. Paul Tudor Jones publicly stated he owns gold as a hedge. Trade 2 is active right now. Gold accumulation at scale. When the crash comes and the Fed prints 5, 10, maybe $20 trillion, gold will surge to $5,000, maybe $6,000, possibly $10,000 per ounce. The people holding gold will preserve their purchasing power, while everyone holding dollars gets destroyed. But here's where it gets really interesting. Trade 1 protects you. Trade 2 preserves your wealth. But Trade 3 makes you rich. This is the profit trade. This is where generational wealth is created. Trade 3 means placing bets that pay off when markets collapse. Put options, credit default swaps, VIX calls. Instruments that explode in value when everyone else is losing everything. Let me show you how powerful this is. 1929. Joseph Kennedy established short positions in the fall of 1929, when stocks crashed 30% in days. Kennedy covered his shorts and made an estimated $15 to $50 million. That's several hundred million in today's money. 1987. This is legendary. Paul Tudor Jones bought massive positions and put options on stock index futures. A documentary crew was literally filming him during this period. October 19, 1987, the market crashes 22.6%. His put options explode in value. He made $100 million in one day. His fund was up 62% in October alone. The documentary captured him on the phone, executing trades, making millions in real. It's the most perfect execution of Trade 3 ever filmed. 2008, Michael Burry and John Paulson. This story is now famous from The Big Short. Burry paid premiums on credit default swaps from 2005 to 2007. His investors thought he was insane. He was losing money every month while housing prices kept rising. But when the housing market collapsed in 2008, those credit default swaps paid out. Massively, contracts he bought for a few million in premiums paid out hundreds of millions when the bonds went to zero. His fund made over $700 million. John Paulson executed the same trade at larger scale. His funds collected $15 billion in payouts. He personally made $4 billion. This is Trade 3 at maximum scale. Years of paying premiums, then the biggest payout in hedge fund history. Now here's what's happening in 2025. That should terrify you. Credit default swaps on commercial real estate securities have spiked 300 to 500% since 2021. Why? Because sophisticated investors believe commercial real estate will collapse. Office buildings sitting 40 to 50% vacant due to permanent remote work. Mortgages that were taken out at 3% now have to be refinanced at 8%. The math doesn't work. Defaults are inevitable. The investors buying these credit default swaps are paying elevated premiums right now. But when the defaults cascade through 2025 and 2026, these swaps will pay out massively, just like the subprime swaps in 2008. But options on major indices, large institutional purchases of puts expiring in late 2025 and 2026. These are bets that markets will crash. During that window, the put-call ratio has been elevated above 1.0, more puts than calls being bought. This indicates institutional hedging. They're buying insurance. They're executing Trade 3. VIX call options. The VIX measures market volatility. It spikes during crashes. There have been large purchases of VIX calls expiring throughout 2025. Bill Ackman has discussed publicly that he's considering hedges similar to his March 2020 trade when he turned 27 million into $6 billion in just a few weeks. The pattern is undeniable. Across 1929, 1987, 2008, and now 2025, the same three trades happen in sequence. Trade 1. Convert to cash 12 to 18 months before. Trade 2. Accumulate gold for wealth preservation. Trade 3. Buy volatility instruments that pay when markets crash. These aren't random strategies. They're mechanical responses to the same setup, but here's what you need to understand. Every major crash follows the exact same sequence. 6 stages. Every single time. Stage 1. The bubble. Asset prices rise to levels disconnected from reality. In 1929, stocks traded at absurd multiples. In 2008, housing prices doubled in 5 years. In 2025, the Buffett indicator is at 185%. Stocks are valued at almost twice the entire GDP. Historic extremes. Asterisk, asterisk. Stage 2, euphoria. Asterisk, asterisk. Everyone believes prices will keep rising forever. In 1929, shoeshine boys giving stock tips. In 2008, housing prices never fall nationally. In 2025, AI will change everything. Valuations don't matter. Stage 3, maximum leverage. Everyone borrows money to buy more. In 1929, 90% margin debt. In 2008, 52:1 leverage in the financial system. In 2025, margin debt near record highs. Leverage everywhere. Stage 4, the trigger. Something causes a small decline. In 1929, the Hatchery fraud in London. In 1987, rising interest rates. In 2008, subprime defaults. In 2025, it could be commercial real estate collapse, a major bank failure, a geopolitical shock. The specific trigger doesn't matter. Stage 5, forced liquidation. This is where it gets ugly. Leveraged investors face losses. They get margin calls, they're forced to sell. That selling drives prices lower, which triggers more margin calls, more forced selling. This creates a cascade, a death spiral. Prices fall not because of fundamentals, but because of mechanical forced selling. This is why crashes happen so fast. Stage 6, panic. Fear takes over. Everyone sells everything. Liquidity disappears. Prices gap down violently. The VIX spikes to 50, 60, 70. Markets fall 20, 30, 40% in weeks, and this is when the 3 trades pay off. Trade 1 means you're not being liquidated. You're not forced to sell. You're protected. Trade 2 means you're not holding depreciating cash. You're preserving wealth in gold. Trade 3 means you're profiting from the crash itself. Your puts, your swaps, your VIX calls explode in value. Now here's the timeline. Based on the historical pattern, we are 12 to 18 months before the crash right now. That puts the crash window at late 2025, or first half of 2026. The 3 trades are already active. Trade 1, substantially complete smart money is out. Trade 2, accelerating central banks buying gold at record rates. Trade 3, being established credit default swaps. Puts being purchased when the crash comes. The S&P will fall from current levels around 6,000 down to 3,500 or lower. That's a 40 to 50% decline. Commercial real estate will collapse. Regional banks will fail. Unemployment will spike from 4% to 9%. And then comes the implicit 4th trade. After you've preserved capital with trade 1, protected wealth with trade 2, and profited with trade 3, you deploy everything at maximum fear. You buy stocks when they're down 50%. You buy real estate when it's being foreclosed. You buy businesses when they're being liquidated. Is what Kennedy did after 1929, what Buffett did in 2008, what Ackman did in March 2020. 4th trade creates generational wealth, but you can only execute it if you successfully executed trades 1, 2, and 3 first. So what should you do? Most people can't execute this perfectly. They don't have hundreds of millions. They don't have access to institutional credit default swaps, but you can. Execute simplified versions. Trade 1. Raise cash. If you're 70% invested in stocks, reduce to 40%. Hold the difference in cash or short-term treasury bills. Yes, you might miss some gains, but when the crash comes, you'll have 30% protected. That becomes buying power at the bottom. Asterisk, asterisk, trade 2. Buy gold. Asterisk, asterisk, put 5 to 10% of your portfolio in physical gold or gold ET, not gold mining stocks. Physical gold. When the Fed prints unlimited money, gold will surge. This preserves purchasing power. Trade 3. Buy protection. Buy put options on SPY, the S&P 500 ETH. Buy puts expiring in 6 to 12 months, with strike prices 10 to 20% below current levels. You'll pay 1 to 3% of portfolio value. If markets crash, those puts could return 5 to 10x. If markets don't crash, you lose the premium, but that's insurance. The most important thing, psychological preparation. When the crash comes, when markets are down 40 to 50%, when every headline predicts the end of capitalism, when unemployment is spiking and banks are failing. You have to be ready to buy. You need a list of quality companies right now. Apple, Microsoft, Visa, Johnson & Johnson. Companies with strong balance sheets, low debt, products people will always need. When these companies are 50% off, you buy aggressively with the cash you protected, the wealth you preserved, and the profits you made. This is the hardest part, not the technical execution, but having the courage to buy when it feels like the world is ending. That's what separates those who get rich from those who lose everything. Here's the bottom line. The 3 trades aren't secret. They're not insider information. They're a documented historical pattern that repeats because crashes follow the same mechanical sequence, and they're being executed right now in 2025 by the smartest investors in the world. Warren Buffett, $325 billion in cash. That's trade 1. Central banks 3,000 tons of gold in 3 years. That's trade 2. Hedge funds, buying credit default swaps and puts. That's trade 3. The pattern is playing out in real time. The only question is whether you will recognize it and position accordingly, or whether you'll ignore it and lose 30 to 50% of your wealth. Most people will ignore it. They always do. They'll believe this time is different. They'll believe AI changes everything. They'll believe the Fed will save markets. And they'll lose everything, just like in 1929, 1987, and 2008. But a small group will see the pattern. They'll execute the 3 trades. They'll protect capital, preserve wealth, and profit from the crash, and then they'll buy at the bottom and become wealthier than they ever imagined. The choice is yours. The 3 trades have been made. The pattern is repeating. The crash is coming. If this video showed you something you've never seen before, if you now understand that the same 3 trades work before every crash, do 2 things. First, subscribe to this channel. Over the next 12 to 18 months, I'll track every signal, every insider sale, every gold purchase by central banks, every spike in credit default swap prices. You'll see the pattern unfold in real-time. Second, and this is critical, share this video with someone you care about, because when the crash comes, it'll be too late. The trades have to be made before the crash. That's the entire point. This isn't financial advice. This is pattern recognition. The pattern has repeated 4 times in the last century, 1929, 1987, 2008, and now 2025. The 3 trades are the same. The sequence is the same. The outcome will be the same. Position yourself while you still can, because in 12 to 18 months, everything changes, and you'll either be positioned to profit or positioned to lose everything. The smart money has already decided. What will you do?